It's Viktoriya Khusit here with Viki Consulting. And today let's talk about sale of your primary residence. By now, I think everybody knows that if you own a property for 5 years and you live in property for 2 years out of 5 and you sell it, you can exclude, and if you're single, you can exclude up to $250,000 in profits, and if you married, you can exclude $500,000 in gain on sale of your home. However, let's talk about what happens if you buy property and it's your primary residence, and then you convert it to rentals. What do? Can you move in back into your property and then sell it and take an exclusion? Is there certain exemptions? So this video will be short, and this video will talk about specifically rental properties and what you can do to have some sort of a tax relief. So let's start. And before we actually start, please don't forget to subscribe to my channel. Let's look at different scenarios and what you can do. Let's just say you bought a property and it's your primary residence. And you move in, you live in it for 2 years, and then you decide to rent it out and go live somewhere else. So you rent out your property for another, let's just say, 3 years. You decided to sell. Now, when you come to sell, you meet the usage test. You have property for 5 years, and you lived in that property for 2 years. And the main part here is that you start using this property as a primary residence. So you could have lived, let's just say, not consecutively 2 years, but you could have lived 6 months, and then rent it for a year, and then live another year and a half, and then rent it again, and decided to sell. So out of last 5 years, you had it for 2 years as your primary residence, and then you had it as a rental. Now you're selling it. You are qualified under Section 121 to take an exclusion up to $250,000 or $500,000. Let's look at a different scenario. You bought a property and you rented it. And you rented it for 3 years. That was your rental residence. And now you're thinking, oh, you know what? I want to sell it. You're moving back in for 2 years. Now you have 5 years and you want to sell it. You can sell it. Can you take an exclusion? The answer is maybe. So you cannot take a full $250,000 or $500,000 exclusion like in our first example. Why? Because the property was used first for rent and not as a primary residence. However, you can calculate how much you can claim because you did use it for the primary purpose as well. So you are qualified for some exclusion. So now let's look at the formula. And the formula is, so you take the numbers of years it was rented. So rented, and you divide it by numbers of years you owned this property. So let's do it in example. Let's just say you bought something and you rented it. And in this example, it's not necessarily you need to do last 5 years. Let's just say you bought a property and you rented this property for 5 years. 5 years rented. And then you moved into this property and you lived in this property for another let's just say 7 years. For another 7 years. So 5 years it was rented, 7 you lived in it, you had this property for 12 years. So you would take 5 and you divided it by 12 and you will receive 0.42. What do you do with this number? Let's just say you're single and your exclusion is $250,000. You take $250,000 and you multiply by 0.42. You get $105,000. That's how much you can exclude from your income. So basically would be $250,000 minus 105,000. It's 145 need to report. And 105, that's what you can exclude. So even if you rent in a property and then you decide to move into a property and you live in that property for a while, you're still able to have some exclusion. It's just this exclusion is not full as for the primary residence. Now, if you have a question, let's just say you rented a property. You rent a property and then you move into a property. And then you rent it again. What's happening there? It's still the same formula. You still able to take some exclusion because you've been using your property as a primary residence for some time, but you're gonna do the same. You're just gonna calculate all the years you rented the property. You're gonna divide by the amount years you own this property, and you're gonna find your percentage that you can exclude. And then you multiply that percentage by the amount of exclusion. So let's just say you did not sell it for that much more. Your exclusion is not $250,000. It's only $100,000. So you would do $100,000 multiplied by your percentage, and that's what you can exclude. So in our example, if you sell something for, you gain $100,000, you cannot just say, okay, I'm done. It's good because I can exclude up to $250,000. No, you're gonna take your $100,000, you're gonna multiply. In our example, it was 0.42, which gives you $42,000. So $42,000 you can exclude, and $58,000 you need to report as income. And in this example, I'm not covering depreciation, I'm not covering any expenses for selling rental property. This is not the purpose of this video. The purpose of this video is just talk only about exclusion for selling your primary residence. And when you're selling again your primary residence, which was always only your primary residence, you're entitled to the exclusion of $250,000 or $500,000. If you start using a property as a primary residence, but then converted it into a rental, and it's been first 5 years, you're entitled to full exclusion. But if you started with using a property as a rental and then moved in, then you need to follow a formula to calculate what is your limitation and what you actually can claim and what you need to report as far as a portion of your gain. I hope this was useful, and leave me a comment if you have questions, and don't forget to subscribe.